Hey everyone, welcome back. Today we're talking about something massive, how war affects your money, the markets, and the global economy. With all eyes on the growing conflict between Israel and Iran and the US stepping in, it's time we unpack what this really means for your wallet. Let's start with what's happening right now. Just days ago, the United States confirmed strikes on Iranian nuclear sites, supporting Israel in its offensive that instantly sent shockwaves through the global markets. Oil prices spiked, stocks dipped, the dollar surged. Why? Because war creates uncertainty, and uncertainty scares money. When investors see conflict brewing, especially in oil-rich regions like the Middle East, they start shifting their money out of riskier assets like stocks and into safe havens like gold, government bonds, and the US dollar. In fact, gold prices are climbing, and some experts believe it could hit record highs if the situation gets worse. Meanwhile, oil prices are yo-yoing. Iran is a key OPEC member, and any disruption there raises fears of tighter supply. This week, Brent crude briefly surged to its highest in 5 months. That affects everything, from your gas prices to your grocery bills, because energy costs ripple across every industry. But it's not just markets. Central banks are watching closely, too. The U.S. Federal Reserve hinted this week that the growing instability could influence future interest rate decisions. They're already battling inflation, and war can make things harder, especially if oil prices keep rising and supply chains get disrupted again. Now let's talk about the U.S. role. This isn't just about airstrikes. The U.S. is pouring billions into military aid, ramping up defense production, and potentially expanding its presence in the region. That means higher government spending, possibly more debt, and a bigger deficit. It's one reason why economists expect U.S. borrowing to increase this year, and why some fear higher taxes or longer inflation. Globally, the impact is just as intense. Countries like India, heavily dependent on oil imports, are already preparing for economic fallout. Shipping routes are more dangerous, insurance premiums are rising, and emerging markets are facing pressure on their currencies as investors pull money into the U.S. In Europe, policymakers are bracing for another refugee wave. Already stretched budgets could tighten even more, and countries near the conflict zone are preparing for cyber attacks and trade disruptions. This kind of instability also affects trade. Some ports in the Persian Gulf are slowing operations, and insurance costs for cargo ships in the region have soared. That means higher costs for goods, more delays, and further strain on the global economy. So what should you expect next? If tensions rise further, oil could hit new highs. That would push inflation up again, just when we thought it was cooling. Stock markets could enter a correction, especially if more Western countries get pulled in. And the Fed may have no choice but to hold or even hike interest rates to control inflation. But there's a flip side. Iran recently suggested it might be open to negotiation. If peace talks begin, markets could calm. Oil prices would likely fall, stocks would rebound, and currencies would stabilize. It's a delicate moment. So here's the big picture. War doesn't just happen on the battlefield. It hits the banks, the markets, the jobs, and yes, your savings. Whether it's gas prices at the pump or volatility in your retirement account, conflict in one region affects economies worldwide. And that's why it's important to stay informed and diversified. Make sure your investments are spread out, not just in stocks, but maybe bonds, commodities, or international assets. And most importantly, understand that in a global economy, what happens overseas impacts all of us. If you found this breakdown helpful, stick around. We've got more coming on how to navigate uncertain times. Stay smart, stay prepared, and I'll see you in the next one.